What's up guys, Steven Dexter. Welcome to the next YouTube videos, and today I'm going to talk about how to really move down your risk and how to use statistics binding with different patterns and how to really recognize that trends has already formed when the stock decides to reverse on you, and this is how you react. And moving down risk is really good if you want to add more shares into your original positions. So before I get into this video, hopefully you guys really like the previous one. It's just for beginners. Most of you guys that I consider that are beginners. So if you want to know more about statistics, there's a link below and can take you straight to either you can watch trading techniques or you can watch Stock Cylinder. Those two DVDs are really good for beginners and how to really track statistics. If you're interested, click the link below and let's get into how to move down risks. When you see a chart is forming a specific pattern or it's doing its own thing about in the first 30 minutes or 20 minutes, and most of the time you will see the trends has already formed the first 30 minutes. So either it does a huge spike or a huge panic. Most spiking and failing percentages are typically happens in the first 30 minutes of the day. SINT, for example, you see the chart did a massive panic. It doesn't really matter if you got into a trade or didn't get into a trade. It doesn't matter what pattern it is, but you can see when the stock opened up and you can see this massive amount of volume that traded in the open, and it consolidated for a little bit and cracked through right at the open price. So in this case, you can kind of go into a chart and think about it. So when people either you're using Robinhood or you're using TD Ameritrade, those two brokers cannot size in the pre-market or in after hour. So when they see a stock is potential bullish and they see a massive spike right after open, typical people will just straight chase into the stock. It means they want to buy into the stock. Let's say for the best guy that buy right at the open will be at 2.46. So let's assume the first guy bought at 2.46. And he sees the stock is spiking, he's happy, and suddenly the stock decides to crack to 2.46 or 2.45, and he will get nervous because he's afraid of the stock is going to drop more and he's going to be down money on the day. So when I see a position that I was winning at the beginning, then suddenly I'm breaking even, I want to cut my losses. That's their first mentality because they don't want to lose money, they want to cut it even at least. So when the stock dumps to this point, typically it means the stock is on a downtrend level. And when you are using specific pattern, and you can use this people's mentality, that a lot of people who buy or chase right at open are underwater. And if you are using specific pattern, let's say you short at 3, then you're looking to add more. And you can tell people are underwater. So when the stock decides to bounce into 2.7, I can know people who bought it at 2.7 or 2.8, they want to sell to break even. That's where the huge selling pressure coming from. So this panic was predicted. That's why you can add into here. So when you add, let's say 2.6, and of course, if let's say you short at 3 and you add it at 2.6, your average won't be at 3 anymore. Your average will be around 2.8. Now let's form our line right here. Let's say that here will be your average. So 2.8, you add at 2.6. Right now, if it's me, I will move down my risk. It means that typically, if I'm risking this double top, that when I cut my losses, I will be down money. I will be negative. But if I decide to add 2.6 or 2. Let's say I didn't add perfectly. I added at 2.59. Then my average will be drawn down to 2.8. Now, right now, when the stock is on downtrend, my risk will be readjusted into 2.66. It's because stock already formed another top, and if the stock decides to come back or above that level again, I will be cutting my losses. If I cut my losses, because my entry is at 2.8, it means I will be coming out of trade as green. So this is how you really protect yourself when the stock already formed the trend, and if you decide to adding into a winner, typically it will give you more winning. If the stock is going against you, then all your emotional decisions are involved, and that's where you make a really bad entry and exit. So in this case, stocks throughout the day, it didn't really break the 2.66 area. It decides to test that area again and straight failed. So if you are shorting and if you added, always leave something as your risk if you decide to move down your risk, and this risk has to be a very specific level on the chart. So let's say if you decide to add it into a random ad, you see the stock is panicking, you think it's going to drop more, you didn't really think about what your average is going to be. Let's say you add it at 2.36 and if your initial entry will be 3, your average will be drawn down to 2.52. That means, let's say 2.52 to 2.55, then your risk will be around 2.66. So if the stock decides to push above 2.66, then you will be down. This 2.66, it's a key level. You can see it on the chart. You always want your average position will be a little bit above that key point of the risk levels. You're always gonna give yourself a little bit of room if the stock tends to go against you, and you have that little bit of room of liquidity to cover or to exit your positions. Same thing goes with long. So let's say if you bought at very low and you decide to add in your panic, always pick that very key level, a little bit under the key level or a little bit above the key level for shorting. So in that way, if the stock tends to go against you, you will be coming out as small green or cut it even. Because let's say we have a lot of shares, if you want to exit the stock needs to have enough liquidity for it to get out. If there is really thin liquidity, then getting out will be really difficult. It's gonna affect the stock price. That's why you always want to leave a little bit of room for you, and your entry needs to be above the key level. Now let's talk about some charts that a lot of people are really pay attention to. So the first thing when you look at the stock market, you want to look at the entire historical charts, because you want to know what the stock did in the past couple of years or so. But for me, I typically look within a year, so I don't really look before a year ago. And now if you see this consistent downtrend chart, the stock was going down pretty much every single day, then you see this massive drawdown and another consistent downtrend charts. If the stock is trading decent amount of volume every single day, it means people are holding in different levels. So you can't really tell where people are holding. So when the stock tends to reverse again, you don't have that concentrated level of sellers. Let's say some people holding at 4, some people holding at 6, some people holding at 9. And when the stock decides to come back again, and stock was already on the consistent downtrend chart, hit already 0.74, that means in this level, the stock was downtrending so much, and the people who are holding in there are very desperate. When they are desperate, they are tempted to hold. For example, if I tempted to hold a stock, or I bought a stock at 2, and the stock went to 0.5. In that case, I would think I'm very stupid. I didn't really count my losses, and I'm already holding at 0.5. Well, what's the worst? It goes to 0, and I'll lose pretty much all my investment. If the stock is already at 0.5, I'm already down so much, I would just holding the stock to the hoping for it to spike again. So now I bought at 2. Some people bought at 5 or 8. And when the stock tends to spike again, I want the stock spikes to my level, which means let's say I bought a stock at 2, I want the stock spike to 2 to be able to cut it even. Some people bought it at 4, the stock spike back to 4 to cut it even. And when you see this consistent downtrend charts, you don't really see concentrated sellers. That means people are pretty much, sellers are everywhere. So when you're trying to predict the top of these type of charts, let's say when they gap up or do whatever things, and it goes to parabolic, shorting on intraday based on this type of downtrend consistent charts, it's very, very difficult because you can't really find where the seller is. So for something like this, if there's sellers everywhere, it's trading, let's say 1 million or 300K shares per day, then there's about, let's say 30 million overall. People are holding 4, 6, 8. If the stock tends to go parabolic and trading a lot of volume, it's really difficult to overwhelm all those sellers. That means the stock unlikely to spike that high, and also you can't really predict where the seller is and where the resistance level is. That means the stock is not really tradable. So when you are looking at a ticker, you always want to look at the technical side, you want to look at the fundamental side. Technical side, it's very important in the first few days if the stock tends to spike. So the priority is technicals overwhelms fundamentals. In long term, fundamentals overwhelms technicals. When you want to trade short term, technical analysis is always the one you want to look at. That'll be my tips for today. Hopefully this video helps. I will see you guys next time.